How are you?
Thanks for coming, guys.
Thanks for having us.
So I wanted to start off, Andy, Wealthfront has recently offered a cash savings account that you now have the highest interest rate on the market. So you've raised it from 2.24% to 2.51%. So, this is like 27 basis points. Most of your customers are millennials who I thought didn't save at all. Mm-hmm. Why would it matter so much to just raise it by so little? Why does that matter?
To raise it by so little?
Yeah, well, 27 basis points. I mean, if millennials aren't saving, why does it matter to have the highest interest?
Well, I think it's a false narrative. I think millennials, they're not all sitting in their basement smoking weed all day long. That they're actually in the most productive stage of their lives. Millennials, I think, are 1980 to 1995. So the oldest ones are almost 40 years old. They're not 22-year-olds. So they're in the wealth accumulation phase of their lives. And offering the highest rate makes it a no-brainer to engage with Wealthfront. And that's worked out exceptionally well for us.
How well? How's that going so far?
Well beyond our wildest expectations. Our growth rate's up about 6x. And so it was a big move to raise the rate to the highest in the market, and it appears to have paid off.
Yeah, because you started as a robo-advisor investments, and now this is more of a banking service. Is that indicative of what Wealthfront will be offering in the future?
Yeah, well, millennials keep the vast majority of their money in banks. I think that they are a little bit more wary of financial markets. They've grown up in a time of, from the financial crisis to today's uncertainty with Trump, and they tend to be a little bit more conservative. And so in order to serve them with a full suite of financial services, we found that leading with an FDIC-insured high-yield cash account was the best way to engage. And then we have to build features over time in order to make it a no-brainer. And so that's where we're going with our self-driving money vision.
So speaking of what millennials are doing with their money, Venmo now has 40 million users, which I think about half, which is equivalent to about half the millennials in the US, and also my dad, who recently started to use Venmo a couple weekends ago. But what's been surprising to you in terms of millennial financial behavior? What have you learned so far?
Yeah, I think as we look at millennial behavior, the big thing is that they're really interested in splitting payments and doing things that are more experience-based with their friends. So it's less about buying the next pair of jeans and a lot more about what can we do together with our friends. I think the other thing we see a lot of is that they appreciate the simplicity that items like Venmo create for them, where it's not awkward to ask for money. And it's created a network effect that we're using to continue to grow the network, to get people like your dad involved, and then he sees his network start growing and becoming on Venmo. And there's more velocity in the transactions as we get more and more people in the Venmo network as a whole.
Yeah. We previously had Walt Bettinger of Schwab, and we were talking a lot about, millennials and their price sensitivity and what it means to cut fees and which services are free. And Venmo is a free service for the most part for millennials, and you have also at Wealthfront offered a lot of free financial products to these customers. I mean, how do you, how price sensitive is this generation? Is it just going to be kind of loss leading to gain volume, or is there anything that millennials will be willing to pay for?
I think they're willing to pay for services that you provide that are better than market, right? So we're in a world right now where there's a lot of commoditization out there, and a lot of different products are starting to clone one another. So they have more options than have ever been around in history. So when they're choosing between services, it's easy to crowdsource what's cheapest. Is this a good product to use or not? That information passes. It's not only your friend group, you can search the internet. So as you develop product for them and add value for them, you need to be very specific in what you're trying to drive and differentiate it. And in those situations, they're willing to pay. And I think instant transfer was a great example of that for Venmo. We put $1 billion on the product, only 8 months after we launched it, right? And this was really them saying it is valuable for us to have money in Venmo, but at times we need it out, and we're willing to pay you a 1% fee to do so.
Yeah, and it sounds like they are responding to higher interest rates. That's a way they are price sensitive.
Well, our experience is the millennials do more research than previous generations. They're internet savvy and they read the reviews. And we have focused all of our services around 3 pillars of value that appeal most to them, which are price, simplicity, and automation. So I think it's the combination of three, probably in that order.
Yeah. One thing I wanted to ask you, this is sort of a conundrum that I'm trying to wrap my head around. In announcing Project Libra yesterday, the head of the project at Facebook, David Marcus, wrote on Twitter, "We've heard loud and clear that you don't want social and financial data commingled." But isn't that exactly what Venmo does? I mean, these millennials are sharing their financial lives in all these transactions. So do they want it or not?
It's a good question.
They want privacy.
I think there are definitely a segment of users that are willing to share what they're doing financially and with their specific friend group. They don't want it out there necessarily for the entire world. I think there are companies who have tried to do this and it hasn't worked for them, right? And they're drawing, well, I think Facebook's one of them where they're drawing that conclusion. And you've seen that Google has been in payments before and Apple's been in payments before, not necessarily as social. But it's a complicated space, and you really have to be very specific on what you're going after. The market is wide. There's a lot of products and services you can offer, and be very deliberate on what the value you're bringing is. And like we started with a very simple problem, which was it's hard to pay someone back. You need to have cash. You need to have exact change. You can lose it. You can't track it. There's no ledger of how you spent your money at the end of a week, month, year. So something like Venmo simplified that entire experience for them. Right? And in those situations with a close friend groups, they're willing to share.
Can you do anything with that data? Is that data valuable to Venmo or PayPal?
That data is exceptionally valuable to us. So we can see how social groups are interacting. We can see how spend is changing over time. We can see categories of spend. So there's a lot of information we're gathering off of it. I think some that we're figuring out how to make valuable today, but we continue to see that there will be more value as you build out the social graphs of how people are interacting with each other and the velocity of money that happens within Venmo.
What is that? I mean, what could that dictate in the future in terms of product or Venmo's next move?
Yeah. So I think there's a lot of different ideas we have with it. But for example, if you tried to get into lending and you knew different groups of behavior and everyone was going on a trip together, right? Or you looked at people's instruments in their wallet and said, hey, these people have debit cards, but they're ready for credit cards. Right? We understand how they're spending money and they've never had an ACH reject or anything like that. That provides a lot of richness for us to go back to the consumer base and offer them some products and services.
And Andy, I know Wealthfront, you're harnessing data in many ways in terms of what you offer and also potentially collecting more data that maybe you'll use in the future. Can you talk a little bit about that and how you see data?
Sure. Our average client links about 6 accounts to Wealthfront.
Wow.
And that enables us to really understand their financial lives, to be able to provide the most appropriate and personalized advice possible, even more personalized than an advisor could, and target the products that they most want. So we see how they've behaved, and we can deliver them products that have superior price, simplicity, and automation to what's offered today.
Does that help them beat the market?
You know, beating the market is not possible. There's a lot of research that has shown that it is not possible over the long term. So I don't think that's one's goal. I think our chief investment officer, Bert Malkiel, who founded the concept of an index fund, says you can't beat the market, so you shouldn't try, just minimize fees, minimize taxes, and diversify.
And that's Wealthfront's strategy in a nutshell?
That's the investment strategy.
The investment strategy, yeah. I'm going to come to the audience for questions in a moment, so please get them ready, raise your hand, they'll come to you with a paddle and a microphone. But you know, there's a lot of new competitors who are now trying to do a little bit of what Wealthfront's doing in some ways, and there's also competitors who are offering high yield savings accounts, not quite as high as you. A lot of fintech companies are just starting to look a lot more like banks and offering a similar array of services. I know you've said in the past that your customers pay you not to talk to them, but how do you compete, with the legacy financial institutions and the new startups who are entering the market?
Well, for us, the keys are trust, as you've heard before, and the technology that underlies our vision of self-driving money. So this idea of a financial supermarket or a financial hub is not new. 40 years ago, Merrill Lynch innovated with something called a cash management account. That was the first time you could get banking services and investment services from one firm. And that catapulted Merrill Lynch into the lead among financial institutions. And then 20 years later, Schwab introduced banking services. They were the next generation. And now 20 years after that, you see us and a number of other people going after that market. But most of the people who are trying to build next generation banks are either serving the unbanked or the people who are living paycheck to paycheck. Chime is a great example. They're doing exceptionally well. And the major value proposition is we get you your access to your paycheck sooner by not keeping the float for a couple of days. Well, that's great for someone who's living paycheck to paycheck, but if you're a millennial who saves, then you don't use a debit card. You don't worry about the paycheck to paycheck. You want to put all your spending on your Sapphire card and pay a bill at the end of the month. So we think that if we can deliver trust, and no one keeps as large balances with their vendors as our clients do. So our average client keeps over $60,000 with us. And no one else delegates the management of their finances to their service provider like us. So that's one of the ways that we think we've earned trust. The other thing is that we've focused on automation and an advice engine that allows us to deliver what we call self-driving money. You'll be able to direct deposit your paycheck, automatically pay your bills, and then route the money to the most appropriate account for your situation and goals by the end of this year. And that has required a 3-year investment in technology.
On your behalf.
Yeah, and we haven't seen anyone invest in the banking and brokerage automation platform and the advice engine.
Yeah. Did we have any questions? Was there one over here? Yes, and please tell us who you are.
Hi, my name is Guy. I'm from eToro. So the question is for Andy. Andy, you started as Kaching. I'm interested in knowing why the concept of social investing didn't work out for you, and you pivoted away to something that turned out to be really successful, which is Wealthfront today.
Well, you know, I teach, for the last 10 years, I've taught a course at Stanford Graduate School of Business on product market fit. And one of the most important insights about product market fit is almost no one succeeds at their original strategy. Now, everyone revises history because consumers want to believe that you always intended to build the product that they did. So every great marketer is a revisionist. In our case, we started with an investment business. The mission stayed the same, which was to democratize access to sophisticated financial advice. And the software stayed the same, 90% of it did at least, but the user interface changed. And so we evolved from what we were in Kaching to what we've become today. And we've evolved even further with the next generation banking focus. So we came to realize that the core elements of what we do are automation and the advice engine. How can we best put that together to serve the biggest problems of our clients? And if you are riveted on delighting your client, the message might change over time, but that's not a sign of weakness, that's a sign of strength.
Get your questions ready, and please raise your hand if you have them. But in the meantime, I have a question for you, because I know we've been talking a lot about Facebook Project Libra over this past week in this conference. But of the many articles I've read, I've seen them describe Venmo as a competitor to, or Libra as a competitor to Venmo. But PayPal, Venmo's parent company, is also a partner with Libra. What does that mean? I mean, are you going to compete, or are you a partner, or what does the future look like there?
Yeah. So I think we're not sure exactly what the future is going to be, right? I think we're still trying to figure out the charter of Libra, but we're really interested in the blockchain. We're really interested in the technology that, when you start aggregating some of the large players in the space, can simplify financial transactions. And PayPal wants a voice in that and wants to have a part of that. The nice thing of being part of PayPal as Venmo is that we get to piggyback on anything they do. So I don't think Venmo will be driving the strategy there, but I do think we will piggyback on anything that we find successful.
Do you think Venmo could potentially have its own blockchain one day?
I don't foresee that in my vantage point at this point in time. Yeah.
Yeah. Do we have a question somewhere? No questions. Well, I have more. So, I mean, PayPal acquired Venmo. There's a lot of players in the fintech space in terms of robo-advising, in terms of banking, like we talked about. Do you see your future as an independent company, or is this something that Bank of America or another big bank could acquire, or even Betterment, your slightly larger competitor?
You know, companies are only acquired if they want to be. And for 25 years, I was a venture capitalist. I was a co-founder of Benchmark Capital. We never wanted to back a company that intended to be acquired, because the likelihood that you could get the upside that you wanted was very, very low. So we liked backing entrepreneurs who wanted to go for it. And that meant building a large, independent, publicly traded company. Being public is a really, really good thing. And so when I started Wealthfront, my goal from the very beginning was to build a large, independent public company. In my experience, there are only 2 times you consider selling your business. One is if it's not working, you try to sell it before anyone realizes it, which is, by the way, why most technology acquisitions fail. It's not a surprise. And the other one is if someone just pays you such an outrageous price, you can't say no. But everything that we do at Wealthfront is focused around the long term. And this initiative to build a next generation bank, we think that's something that has legs for a long time. Why would we consider selling?
Yeah. I see a question from Adam Lashinsky over here.
Thank you. Andy, nice to see you. If you could keep going on venture capital for a moment. Walt Bettinger, the CEO of Schwab, made what I thought was a very interesting comment earlier, that one shouldn't confuse the success, shouldn't confuse the progress of a company that is spending venture capitalists' money with success. Could you comment on that from your perspective?
Sure, I never focus on valuation. I always focus on revenue and profits.
I mean the fact that they don't have to make money because they have this source other than cash flow.
You mean like Amazon? So I think that's a ridiculous argument. If you're going to build a great company for the long term, you have to put in place, you have to make the decisions that will lead to the best outcome. One of our 4 corporate values is endurance. So everyone at Wealthfront knows that if you have a trade-off between the short term and the long term, you make the decision that's right for the long term. We're fortunate that we have long-term investors in the company, and they're in no rush to see us go public. I'd actually like to go public before they would, because I think that brings a lot of credibility. The idea that we just want to spend venture capital, that's crazy. We want to serve our clients, and we want to build critical mass so that we can pass along more and more of the savings. You know, there are so many excesses in the financial industry, and we think our mission is to minimize those excesses and put them back in the hands of the consumers. And great public companies do that, great private companies do that.
Before we wrap up, I have a quick question for both of you, because we just found out a little while ago that the Fed is keeping interest rates steady, potential to lower them in the next few months, but maybe not this year. Both of your businesses make money by the interest that you can collect. And so lower interest rates, I mean, is that, or even where they are now, which is relatively low historically, is that bad for your business?
For Venmo, it's not a major factor in our business one way or the other. I think the health of the US consumer, and particularly the millennials, more of our focus. I think it's been such a big part of our business, watching their spending patterns, watching how they're interacting with each other, understanding the different products and services we can offer them. We've really focused a lot of time building a 2-sided network where we've got consumers. With all the consumers now, you can go on Uber, go on Grubhub, take your ride, get your food, split it immediately, do seamless. So that's been a big focus of ours. So we are interconnected with commerce in general. We're on 2 million PayPal merchants where you can check out with Venmo. So the health of the US consumer, in particular millennial and mobile, is very important to us.
Ironically, when interest rates go up, that's good for us. And the reason is that historically, when rates went up and down, banks would would raise and lower the rates that they would pay to consumers. And then when the financial crisis hit, they no longer had to pay consumers interest on their deposits, and they got used to it. So when rates went up, they raised their mortgage rates, but they didn't raise the rates that they pay to consumers. And that just pisses consumers off. So just being able to deliver the market rate to consumers endears you to them and generates more trust. And that trust leads them to actually buy more financial services from us. So ironically, when rates go up, that helps us.
Great. Well, that's great news. Thank you so much. We're out of time.
Thank you.
But it's great to have both of you.
Thank you.